Welcome back to our series on understanding the introduction to financial services industry. And this video is going to deal with understanding margin. And margin is very complicated, but pretty interesting. I hope you'll enjoy this. I always do the disclaimer, basically said that this is not a deep dive. You're not going to walk around here as an expert in margin, but it's a high level overview. It's meant for people who are just looking for an introduction. If you're looking for a real deep dive or you're already an expert in this, go get sources like there are other sources out there, but the book After the Trade is Made is a great book. Everything I'm going to present here is going to be available on Investopedia. If after you see this video, you've got questions on any of the sections or any of the materials, go to Investopedia. There's great information there. I'm not going to give any financial advice. I won't be giving you advice on how to make money on margin or trading. That's not the purpose here. So let's start. What is a margin account? So brokerage firms have different types of accounts. They have IRA accounts, they have Roth accounts, they have cash management accounts, they have investment accounts. One of the types of accounts that a brokerage firm has is a very specialized account called a margin account. Margin account is a brokerage account in which the broker lends the customer cash to purchase securities and other financial products. And then any of those products that are purchased are held in the brokerage, in the margin account. So a margin account is where the broker lends the investor money to buy securities that are then held in the account. When trading stocks, a margin fee or interest is charged on the borrowed funds. So the money that you borrow to buy stocks, you have to pay the broker back with interest. That's simple. The loan in the account is collateralized by the purchased and by the securities purchased and the cash in the account. Because the customer is investing with borrowed money, the customer is using leverage, which will magnify the profits and magnify the losses. So what is margin trading? Margin trading means the investor borrows money from the broker to invest in stocks. The investor uses the assets they own in the account as collateral for borrowing money from the broker. It increases the buying power of the investor. It allows the investor to be able to buy more stock. Margin trading is a way to magnify the investor's buying power by borrowing money from the broker. So the amount the investor can borrow varies, but the current number, the limitation is 50% when trading stock. And I'm going to get into this. But basically, if someone has $5,000 cash in a margin account, they can borrow up to another $5,000. So their cash ownership in the account is 50% of the total value of the account. So I used the term earlier, leverage. Let me try to explain what I mean by leverage. That a margin account. We say the one reason people like margin is that it provides leverage for the investor. So let's look at a regular account. In a regular account, the investor, let's say the investor puts $5,000 in the account, and then they buy 1,000 shares of stock at $5 a share. And then the stock doubles. It goes up to $10 a share. So they now have $10,000 worth of stock, and their initial investment was $5,000. They double their money. Now let's look at that same event in the case where it's a margined account. In this case, it's a margin account. The investor puts in $5,000 in cash and then borrows an additional $5,000. That gives the investor $10,000 in buying power, which is then used to buy 2,000 shares of XYZ stock at $5 a share. So when the stock then doubles to $10 a share, the investor now has $20,000 in value in that account. So you've got 2,000 shares at $10 a share. And this means the investor can now can sell, the investor can sell shares to pay off the $5,000 loan, which will leave the investor with $15,000 or 1,500 shares or $15,000. So the investor started with $5,000 of their money, and now they end up with $15,000. They tripled their money, right? Whereas in a regular account, you would have doubled your money. In this account, margin, by using margin to create greater leverage, greater buying power, you tripled your money. So that's why we say that margin accounts create leverage and increase your potential upside. Now, in this example, we're talking about a stock that doubled in value. Obviously, if the stock didn't perform as well, or if it went down, margin would have increased your loss. I used the term buying power before. I just want to take a moment to explain buying power using the same example. Buying power, also referred to as excess equity, is the money an investor has available to buy securities in a trading context. Buying power equals the total cash held in the brokerage account plus whatever's available in margin. So in the example I gave you earlier, where we had $5,000 in cash in the account, and we could then borrow another $5,000, that gave us $10,000 in buying power that we could then use to buy stock. In this case, 2,000 shares of XYZ share at $5 a share. That's what buying power is. All right. Now, what is a marginable security? Securities that may be posted in a margin account as collateral are known as marginable securities. A marginable security is one that qualifies for investors to purchase on margin. Now, not every security will be qualified for the investor to buy on margin and hold in a margin account. So, for example, the brokerage firm, since they're lending you the money to buy the security, they want to make sure that you're buying securities that are not a highly volatile, high risk, or low value securities. Holdings of marginal securities add to the investor's buying power. So not only, marginal securities are what you can buy on margin, it's also what securities you can hold in the margin account and use as collateral to collateralize your loan and how much money you have available on margin. And again, the downside is that there can be calls, and we're going to talk this in a minute. So that's what marginal securities are. What are non-marginal securities? Non-marginal securities are securities that are not allowed to be purchased on margin at a particular brokerage or financial institution. And it's going to vary from institution to institution. Different brokerage firms are going to have different rules on what they consider non-marginal. And basically, with brokerage firms says, we're not going to lend you money to buy those securities. You have to buy those all in your own cash. Most firms will have a list that will be maintained and be updated daily with a list of non-marginal securities. Securities that the brokerage firm will consider higher risk, higher volatility, that they won't let you buy on margin, and they won't use as collateral from margin. Holdings of non-marginal securities do not add to your buying power. So if you have a margin account and you've got some penny stock that you add into the account, you can hold it in the account, but it won't add to your buying power calculation. Now, what are non-marginal securities? They're recent IPOs. They're very volatile, risky. They're penny stocks. There's over-the-counter bulletin board stocks. There could be a lot of different things. And again, it's going to vary from from brokerage firm to brokerage firm. Different financial institutions have different rules on what they consider non-marginal. The risk department in a brokerage firm is going to come up with the securities that they're going to say, hey, these are securities that we consider to be non-marginal, securities that we consider should not be purchased on margin. We're not going to lend you money to buy these securities, and we're not going to let you use these securities as collateral for your margin loans. And the goal here is to keep securities away from the margin investors, is to mitigate the risk. That's what we're talking about here. So we've talked about margin trading and having a margin account. And the question comes up is, is there a risk? What's the risk? Are these risky things? The answer is trading on margin is very risky. Margin accounts are meant for sophisticated investors, right? They're only suitable for sophisticated investors that have a thorough understanding and have other investments and risk requirements for trading with margin, right? So it's not, these are things that you have to go into with your eyes open and really meant for a sophisticated investor. You should know what you're doing because there is a certain amount of risk. A margin account, you cannot use margin for individual retirement accounts, your IRAs, for a trust or fiduciary accounts, right? For exactly this reason, right? If you have an IRA, you don't want all your IRA retirement money to be tied up in these high risk margin transactions. It's not appropriate. It's not appropriate. Also, brokerage firms are going to be required, if you set up a margin account, you have to have at least $2,000 cash in the account. Now, some brokerage firms are going to require more than $2,000, potentially a lot more than $2,000. Brokers will come back and say, hey, their rule could be that they want you to see $10,000 in the account in cash. You fund it with at least $10,000 in cash or so. But the regulatory requirement is $2,000. We're going to talk a little bit about what's called Reg T margin, right? Now, again, I'm going to go through this. There's really, don't get confused. There's two Reg T margins we're talking about. There's initial margin under Reg T, and there's maintenance margin under Reg T. So Reg T is a Federal Reserve Board provision which aims to regulate extension of credit loans, right? Loaning the money, loaning the broker loan to the money, and requires an investor has a minimum initial ownership of 50%. Right? So you notice that this is it's a Federal Reserve Board regulation. It's not a FINRA regulation. It's not an SEC regulation. And that's because this is a loan, right? The broker is loaning you money. So it's like covered in this under the Federal Reserve Board. It's a loan, right? And what they're going to say is, hey, if the broker's loaning you money to buy assets, you have to have at least 50% of the money for that asset. The broker can lend you the other 50%. But you, the investor, you have to have at least 50%. The broker can't loan you 90% or 80% or 60%. The broker, you the investor, have to have at least 50%. Now, a brokerage firm can say, hey, the Federal Reserve Board says you have to have at least 50%, but we're going to have our own rule that says you have to have at least 60%. Right? So each brokerage firm can have their own rules. Reg T, now you'll hear this, we're going to talk about calls in a minute, but a Reg T call is issued when a customer doesn't have enough cash in their account to cover this 50% requirement. So if you're doing the initial purchase and you don't have that 50%, the investors can be notified they have to add more cash to their account in order to bring it up to the 50%. And again, this is we're talking about Reg T on the initial margin. So what's initial margin? Initial margin is the percentage of the purchase price of the security that must be covered by cash or collateral when using the margin account. This is on the initial purchase. It's a Federal Reserve Board's requirement, right? And this is only the minimum. The investor could say, hey, look, I'm going to put up more than 50% in cash, or the brokerage firm may require more than 50% in cash. But on the initial purchase of the security, right, the investor has to have at least 50% of the cash to buy the security. Again, brokerage firms can set their own requirements. It could be higher. So let's go through this example. We got an investor. And this is the initial funding of a margin account and the initial purchases of securities. So the investor puts $5,000 into the account. So the investor has $5,000 cash in the account. And that means that the investor can borrow from the brokerage firm up to $5,000. That means that the investor put in $5,000, they can borrow $5,000. So that gives them a total buying power of $10,000. So on the initial setup of the account, the buying power is $10,000. $5,000 is the investor put in cash, and $5,000 is borrowed. Now, this would meet that 50% requirement, right? Because the investor owns $5,000 of the total $10,000, which is 50%. So that this would be legitimate. This would be fine. With this, you could buy securities. You could buy up to $10,000 securities. Now, as I mentioned earlier, a brokerage firm could have their own rule that says they require 60%. Where in that case, that particular broker would say, hey, if you want to borrow from us, you've got to put up $6,000 and we'll loan you $4,000. Or you got to, so it depends from brokerage firms, but the minimum set by the regulatory authority is 50%. And many brokerage firms will just keep that 50%, right? So, and that was the initial purchase of securities. That was your initial margin. But let's talk about what is maintenance margin, right? The initial margin requirement is different than the maintenance margin. Maintenance margin is the percentage of equity that must be retained on an ongoing basis in the account. So the initial margin is that 50%. That's what you need setting up the margin account and acquiring an initial acquisition of securities. When you first buy the security, you need that 50%. But now you've got the securities in your account and you just hold them. And 2 months go by, 3 months go by. You have to maintain a certain level of ownership. That's the maintenance margin portion, maintenance margin. So maintenance margin is the amount of equity that must be kept in a margin account going forward. The minimum maintenance margin requirement by Reg T is 25%. That means an investor must maintain enough cash or collateral value in the account to cover 25% of the securities owned. Maintenance margin helps keep account holders to maintain collateral in the account should the value of the securities fall. Some securities, especially volatile ones, have higher margin requirements set by the brokerage firm. So again, although the 25% rule is what's in Reg T, an individual brokerage firm could set their own requirement that's higher. The individual brokerage firm could say, hey, we're going to require 30% or 40%. But the minimum requirement by the regulators is 25%, right? So we talked about initial margin. That's what you need when you buy the security. Now the security is in the account and all you're doing is holding it. You have to have a maintenance margin going forward. So what does that look like? Let's go through the example. So let's say we had $10,000 of buying power available in this account. And that was the initial purchase. we bought 1,000 shares of XYZ Corp at $10 a share. That was the initial investment, right? So we bought $1,000, 1,000 shares at $10 a share. Total value was $10,000. It meets the 50% rule. You're all set. This is all valid for the initial margin, right? Now, we also commented some brokerage firms can set higher than 50% requirement, but let's just say the minimum requirement is 50%. So what happens then? So then like a month goes by, you bought the securities, you hold them, you met the 50% on the initial purchase. Now a month or two goes by, and now you're subject to the maintenance margin, right? So what happens is later, price drops from $10 a share to $6.60 a share. At this point, you've got 1,000 shares at $6.60. That's equals $6,600 in the value of the account. You've now dropped below that 25% mark, right? Because the total value of the account is $6,600. You have a loan of $5,000. So the total assets in the account, $6,600, less the loan of $5,000, means the investor's equity is only $1,600. And $1,600 is 24% of 6,600. So the investor's equity, the investor's ownership of the assets in the account have dropped below 24%. In order to maintain ownership in this account, this investor has to maintain 25% by rule. Now, as again, I can only emphasize this, individual brokerage firms could set their own rules of higher. A brokerage firm could require that you have to own 30% or 40%, right? It depends upon the brokerage firm and the account and individual rules, but the minimum required by the regulators is 25%. So in this case, this is going to generate a margin call. And a margin call, the broker is going to contact the investor and say, you must add cash or securities of value, marginal securities that are marginal securities to this account to bring the value of the account back into the 25% rule. So the investor has to add either cash to this account or marginable securities that will increase the total value of the account so that the investor equity increases to 25%. If that doesn't happen, then the brokerage firm may have to go out and start selling the client's assets to generate cash to bring this back into compliance. So what are margin calls? We just kind of went through this. A margin call occurs when the value of an investor's margin account falls below the broker's required. And notice, it's the broker's required. We talk about the minimum under Reg T, but brokers have their own requirements that are set up when the client opens the margin accounts. An investor's margin account contains securities bought with borrowed money, and that's why this happens, right? A margin call refers specifically to a broker's demand that an investor deposit additional cash or securities into the account so that it's brought up to the minimum value known as the maintenance margin. Margin call is usually an indication that one or more of the securities held in the margin account have decreased in value. When a margin call occurs, the investor must choose to either deposit more money in the account or sell some assets held in their account. They have to bring it back into compliance. So margin calls are demands for additional capital or securities to bring the account up to the minimum maintenance standard. Brokers may force investors to sell assets regardless of the market price. So in other words, let's say you've got a stock that's in the margin account and for whatever, something crazy is happening in the market that day and the stock is taking a dip today, but it's going to bounce back tomorrow. It doesn't matter. If the price is down today, you get a margin call. You have to either add cash and ride this out until the stock comes back, or you have to start selling. And that's why it can become very risky for clients when you have volatile securities. So let's go through a total example here. Now let's say we've got an investor, and I picked some crazy numbers here. So excuse me if these numbers sound a little funny, because I based it off on Google. Let's say you've got a trader, an investor, and he's doing great. He's got $292,000 in the account in cash. He's doing terrific. So it's almost $300,000 of cash in the account. That means for all the cash in his account, he can borrow an additional $292,000. So in this case, this investor, he puts $292,240 in the account. He borrows another $292,240. He's got a total value of the account and buying power of $584,480. Now, Google is selling for $292,040. So this investor says, great, this is what I want to do. I want to buy using the cash I had. I had enough cash to buy 100 shares. I'm borrowing cash to buy another 100 shares. So I'm going to buy, this trader's going to buy 200 shares of Google at $2,922.40 a share. And that's the Class A Alphabet. Alphabet's the name for Google, right? So great. So this trader, this investor is using leverage. He's using his cash plus borrowed money for Google. And this is fine because the total loan amount was $292,240. The value of the account is $584. It's 50% for the initial margin. That's fine. He's got it. Now, time goes by, and this guy has 200 shares of Google, Class A, and Google goes up. It goes up to $3,000 a share. So now that's great. The total value of the account is $600,000, and he's got equity of $308,000. He's got his maintenance margin is way over the 25% number. He's 51%. So he's actually leveraging. He's leveraging his use of margin to make money, to profit on this account. Now, let's say another month goes by and something happens. A problem with supply chains, people's Apple phones are exploding in their ear, and Apple TV is going down the tubes. And let's say Apple goes down, and it drops down from that $3,000 a share to $1,910 a share. So this investor had 200 shares at $1,910 a share. That gives him a total value of the account of $382,000, which sounds great, but when you look at it, he had borrowed $292,000. So his total investor equity, his total equity in this account is only $89,000. Reg T says his equity has to be at least 25%, and he's now at 23%. So this is going to generate a margin call. This investor could be contacted. The investor can say, look, I know Apple's going to pop up tomorrow. They're coming out with new products. This is just a momentary thing. This investor can be told, you must add cash to this account to bring it back to 25%. You can add cash or you can add securities. They have to be marginal securities. But if you don't, it's going to generate the margin call, and the broker, if you don't add cash to this account or securities that are marginal securities to increase the total value, and you don't bring your ownership stake up to 25%, then the brokers will be forced to sell at whatever the current market price is, shares, until they can bring it back into compliance. So he would have to start selling. It doesn't matter what the market could be having a terrible day that day, and you're selling it at a fire sale price. But the broker will be forced to do that. So the investor is being told, either you add securities or cash to bring this back into compliance, to bring your equity stake up to 25%, or we're going to be forced to sell. Okay, so again, different brokerage firms can have different can have higher stakes and higher than 25%. They can have a rule that says they want the broker to have 30% or whatever. Now, just one comment on margin. Everything I've talked about has been margin trading for equities, for stocks. I haven't talked about options. And that's been deliberate because options have their own rules. Options have their own rules. They have their own Reg T requirements. It's a different animal, and I have deliberately left it out here. So you should. The only thing I want you to walk away with is an understanding that everything we talked about has been about stocks, and options are a different animal that are handled differently. So thank you for your time. Again, I'm Paul Judge. If you have any questions, please feel free to reach out to me. My email address is listed here. Also, my LinkedIn contact. I am an independent consultant. I'm available to do training, advising, projects. I am available as an independent contractor, and feel free to contact me if you want to engage my services. So with that, thank you for your time, and have a great day.